Well, thank you for your very kind introduction. And probably if I was truly rational man with capital R and capital M, with such fine words, I should just come up and say, thank you very much and sit down. Because there's only one way this can go after that introduction, but I'll try my best to see what I can do. Now I'm checking the time here because as you know with academics, we like to talk. And among academics, I'm known as someone who really likes to talk. So if you want to get out of here tonight, I've got to keep my eye on this clock and make sure that I don't just keep running on. So with that, let me get started. First, the topic for tonight is the evolution of finance science and financial innovation, past, present, and future. Now, the finance that you've studied and those of you who are already in practice are using today is what we sometimes call modern finance. I mean, finance has been going on since the beginning of time. We've always done some kind of form of finance, but the finance that we are taught, the finance that we use in practice, really is fairly young. And it's based on the science approach to it, that finance being a science, and on the role of financial innovation. And I want to show you, take you through, look, I assume most of you are interested in finance. I mean, you may have other reasons, but most of you are in finance. I think it's useful to, at least once in your career, to look at the path at which how finance evolved from the past to where you are today. And I hope it will give you some insights for the future. So that's my objective tonight. And I'm going to start here by first saying finance is important. There's some that say that there's really a dichotomy between the real economy and the financial economy. That's a fiction, in my view. The two are inexorably connected to one another, and both affect our lives in both those domains. And what I wanted to say is, that the financial system is improved by financial innovation. And financial innovation is driven by three things. Finance science, we understand how finance works better, and that allows us to improve the system. Technology, for sure. I don't hardly have to tell this group that, okay? But there's a third one, need. You can have great technology, you can have great science, but if there's not a feeling of need, it doesn't get done. It doesn't get implemented. So you need these three to make things work. And I'm going to show you a little bit of that in my opening remarks and looking forward. And so, let me just jump right ahead here and say, first, I mentioned finance as a science. It is a science. It wasn't always a science. I would say prior to 1952, finance was, important, but basically it was a series of anecdotes, rules of thumb. The biggest controversy is whether you should use present value or internal rate of return. And there was really no systematic structure. But most importantly, and this was in the introduction about your program of information and finance, most importantly, there were no data. Now, if you look today where there's, trillions of things you can look at, tick by tick, unbelievable amounts of data. It's hard to imagine that wasn't the case. But in reality, up until relatively recent times, there was no data. So you can't have a science if you don't have data to confront the hypotheses, check and see where things, or to use the data to motivate new hypotheses. Well, I picked 1952, and I'm not going to spend a lot of time on this. I don't for this, this is a technical school. You all studied finance, or at least I'm assuming you have. But I want to just take you to, I picked 1952 because that's when Harry Markowitz wrote his paper, which turned into a book, on how to measure and optimize between risk and return. And he formalized that. Now, we've come a long way in some sense since that. And I've put up a list, and this is not complete, of course, of what I see as being the important contributions to the field in terms of mindset, but importantly also data. I'm pointing out, if you'll notice on this list, the Chicago Center for Research and Security Prizes, which in 1960s developed the first comprehensive database of stocks going back to 1926. And that transformed how we could do and what we knew about finance. And there were a lot of great things that we found out that we didn't know was the case. But I'm not going to talk about those. You know them, all right? So what I do want to say is that by the late 60s, maybe early 70s, finance was a full-fledged science. It had models, it had principles, and it had lots of data, okay? And I mentioned before the three elements that were needed. Between 1952 and the late 60s, there was an enormous, as you can see here, an enormous amount of finance science developed. So there was a lot of it. And I need not tell you how technology changed between 1952 and the late 60s when you get things like IBM 360s, Cray computers, and so forth, that look like toys today, but at the time were remarkable. Okay? So you had lots of science and lots of technology. But the science was having almost no impact on practice. Why is that? Need. And that's where I want to take you to point this out. Okay? What I call the innovation catalyst, need. What was the need that happened? In the 1970s, you're all, I think, aware of course, the financial crisis associated with COVID, and then prior to that, back in 2008 here in Europe, 2010-11, the crisis, the great financial crisis. Those are both big crises, okay? But there was a big crisis in the 1970s that I want to call to your attention. And I put a list here so that you get a sense, because a lot of you probably weren't even here, let alone cognizant of what was going on in the 1970s. And what I wanted to point is the number of shocks that hit first the US and then spread around the world. The first one was Bretton Woods, the fall of currencies. Since 1940s, currencies were all fixed. You didn't have to remember what the exchange rate because it was always the same. And they all linked to the dollar, and the dollar was linked to gold, $32 an ounce, okay? And that's fine for trade and everything else. It just wasn't a big topic for most people. All of a sudden, overnight, they all started floating and bouncing around. These were risks, this is over a generation. So there weren't a lot of people in practice who even had experience in dealing with this kind of a shock. They just hadn't even had the experience, let alone the technology. What happened next? We had the first oil crisis. By the way, we didn't know we had to number them, but there were at least two major oil crises in the 1970s, when OPEC and so forth, and those of you who have read about it, if not experienced it, oil went from $2.40 a barrel to $13 a barrel. Now think of that as a percentage change and the impact of that, okay? And then what else did happen in the United States? We had double-digit inflation, over 10%. And not for a month or a year, but persistently over this period. We hadn't seen that since the 1920s, and before that, the Civil War in the middle of the 19th century. There was nobody around who had the experience in the US of dealing with that level of inflation. And of course, what else happened? Interest rates. With that level of inflation, you got double-digit interest rates. And by the way, by the end of this stream of events, of shocks, the US hit a record of 21% interest rate on US Treasuries. Hard to believe, especially given the last 10 or 15 years, okay? Neither of these things had anyone had to deal with before. You also had that the stock market fell in one 18-month period by 50%. Huge effect. What else? There was no money for housing. Why? we had a regulation that said banks could not pay more than 5% interest. It doesn't take rocket science for you to understand that if the government is giving you full faith and credit and a tax break and paying you over 10%, you're not going to put a lot of money into a bank at 5%. So there's no mystery to that. But if there's no money in banks, a big problem with that, but one of the biggest ones is in housing. It didn't matter how good a credit you were. There just wasn't any money for housing. It's a pretty big shock to the real system, as we call it, all right? But now, let me tell you, you thought that this was bad. How about this? We had figured out, we thought, solved these problems, at least at some level, in macroeconomics by saying you either have high inflation because it's overheated, and there were policies, both Fed policy or central bank policies and fiscal policies to address that. And then other times you have economy that's failing, you know, it's doing very poorly with high unemployment. And we had tools for doing that. What happened in 1970 was we had high unemployment as well as high inflation. Think about that. Think of the tools that you could use. One, to fix one, you're going to be putting gas on the fire of the other. A really big challenge, and we really didn't know how to deal with it. I'm not sure we still know how, we know today exactly. Let's just hope it doesn't come back. Okay? So why I go through this with you is to give you a sense, if you weren't there. These were huge shocks to the system that spread out. These weren't just small shocks. And it was not just because of the magnitude of them, but because people really had no experience with dealing with them. Okay? So that is there. Now, in the great financial crisis, if those who remember it or know it, you had a contraction, and actually you had financial innovations was more or less stopped. Regulation came in, stopped doing all of this stuff because it was thought that was the cause of the problem. And as a result, crisis caused a slowdown in innovation, okay? But I want to tell you, and I'm going to show you, that's not always what happens with crises. It can go quite the other way. And in the example of the 1970s I'm going to take you through, it did. All these shocks, the response in the market was not to stop in, pull in your horns on innovation, but to have an explosion in innovation that took place to try to address all these new risks and how to manage them. And so I've listed them here because these are technologies that today everybody takes for granted. There's nothing, you know, of course, but they weren't always there. They all came in this period, driven by this catalyst of shocks. And I'll just mention a few. The option exchange. Well, options are insurance. So we created an insurance market for managing the risks of securities. Financial futures allowed us to try to hedge the risks of currencies and interest rates and bonds and stocks. Those came in. The first electronic exchange came in. In the United States, we created a whole new corporate pension system. The trillions of dollars that are in corporate pension plans that you've seen and people manage, some of the people in this room may even be involved in that, they didn't exist before then. Companies didn't collateralize their pension obligations. It was just a hope and a promise. So that whole part of the industry that you take as standard is relatively recent, okay? Then passive investing. How many people, you know the idea that you invest, passively on the hypothesis that markets work well, and if you don't know an awful lot, a good solution is to just buy everything and hold it, okay? Sounds pretty sensible. I'll just mention very quickly, do a little thought experiment. Go back in time and imagine you've been designated to go into the prudent person committee, wherever that is, that says, is this prudent investment policy? And we went in and said to them, it's a very sensible thing to buy 500 stocks where you don't even know where they're located, let alone their balance sheet. Does that sound prudent to you? If you think about it. That was a tough slide. So I want you to understand that things that we take for granted were tough to get done. So let me move on. That's in there, now that's everywhere. International diversification. Everywhere you go, you get this, even for just ordinary people getting a pension or something, they say you should do international diversification. Prior to the 1970s, institutions didn't do that. I think TIAA-CREF, the insurance company in the United States, was the first institution I know of that systematically put international diversification as a core strategy. So that's not something that was always done and was not always clear. But let me give you some more. Remember I pointed out to you how housing got completely crushed? You couldn't get a mortgage, okay? We created a national mortgage market. We changed the way residential housing was funded. We now had it that anybody could buy pools of mortgages. Anyone could provide capital. We didn't depend on local banks to provide it through, traditional mortgages, but you could lay them off anywhere, and you created an enormous base of capital that had resilience because it was a global base and it worked. What I mean by it worked is, I don't think there's ever been a case in the 40-odd years since this was introduced that the United States has had a mortgage crisis like the one that occurred in the 70s. Was just no money for anyone. Yeah, they fluctuate, sometimes they get tighter, but they're always there because we created a market to solve that, all right? I'm not going to go through each of these. I mentioned negotiated commissions. Well, what did that mean? Well, we had a cartel in the United States. New York Stock Exchange, that if you bought 100 shares, you paid a fixed commission, no negotiation. If you bought 100,000 shares, you paid 1,000 times the commission. Hard for you to believe today, right? But that was reality. Got rid of that. And I believe that was the trigger for the institutionalization of the stock market, which really brought institutions into being the major players in these markets directly. More, okay? And then we had, I'm not going to go through each, but debt securitization, that had a big impact on financing efficiencies. Yes, there have been some problems over the years, but by and large, they have been very successful. And then there was all kinds of innovation. Money market funds, Reg Q is what created those. They weren't created for the purpose that you see them used for today. They were created to substitute for treasuries, for charities and small firms. Instead, they became a substitute for deposits, okay? And high yield and floating rate bonds. And finally, the interest rate swap. Let me just point out to you, if you're a good bank, mean by that you serve your customers, and that's what you want to do, and you're a well-run bank, you want to treat your customers to what they want. Not surprisingly, after double-digit interest rates all over the place, businesses like real estate developers and so forth who needed borrow money for 2, 3, 4-year projects, build buildings and so forth, if interest rates went up 200, 300, 400 basis points, you can go bankrupt. They didn't want to take that risk. They don't know anything about it. So they said to the banks, can you lend to us fixed so we can lock in that cost? Pretty sensible. People who bought mortgages, took out mortgages, they look at their budget. If interest rates go way up and they're floating, you can put them underwater too. Suddenly they see that their coverage has just changed dramatically. So you can understand why they might find that attractive, okay? So the banks, a good bank does what its clients need. Good banks provided fixed rates. But who were their other customers? Depositors. What did depositors want? They want to be able to get their money anytime at whatever they put in. They earn some interest, but they want to be able to get their money whenever they want, whatever they put in there. The only way you can do that is with floating rates. So what did that do to the risk of banks? By satisfying their customers' needs very sensibly, okay, sensible demands, they had enormous interest rate risk. Every time interest rates went up, the banks basically were, their financing was at a higher cost than their income, their sourcing, and they essentially became kind of insolvent. And so governments had to continually kind of step into there. The interest rate swap, I'm sure you know all what it is. It's a very simple contract in concept, okay? Allowed you to get rid of that risk as a bank. It meant you don't have to take interest rate to be a good banker or to provide banking services. And this was a permanent change, because once you had a way to get rid of interest risk but still be a bank, still serve your customers, providing banker services was what they need, then that freed you. And by the way, if you're good at forecasting interest rates, a terrible way to use that fabulous skill is through the loan book. You'd set up a, manage money where you invest in bonds and you know what interest rates are going to do, you're good at it, and you charge 2 and 20 for that. So even if you had the skills, the wrong place to be using it was in the loan book, okay? So this had a really big impact. Now, because of its importance, I'm going to give you a little more example. I'm going to do a couple of examples now of innovations that came in and go through more detail with you, because I think it may help you to think about how the process worked, but also give you some insights into today. I promise you I'm going to get to today. We're in the 1970s now. That's a long time ago. But I'm going to get you all the way up to today and beyond. So bear with me if you would. All right? But I want to just point out for those in the audience that here are the bank earnings as I described them when they didn't have a way to lay off the risk. Their income came from fixed rates. Their cost of funding was floating rates. Rates go up, they're in trouble. Very high sensitivity to that. Independently of credit risk, just of that. Now, how can they do this? Well, if you take an interest rate swap, the bank just enters on the side of the swap where it pays a fixed rate and receives a floating rate. Okay, pretty simple. Now, I quickly want to say, to build the scale of interest rate swaps to operate efficiently at low cost and low risk of defaults, okay, was a major challenge. But to understand what the contract is, it was pretty damn simple, right? But look what it did to the income of banks. Because of the swap, if they did the swap as well, yes, they received a fixed rate from their borrowers. They had to pay a fixed rate on the swap. Of course, the rate on the swap they paid was less than they charged their borrowers, so that spread was their compensation for banking services. And then on the funding side, what did they do? They got paid floating rate, okay, which was higher than the floating rate that they paid on their deposits, and they made another spread for providing that. And what you see is that from that, interest rate risk became de minimis. It was no longer the major factor for a well-run bank. It was gotten rid of. It proved that you don't have to be a great forecaster or manager of interest rates to be a good banker. That was a different skill set. Important effect on the real economy, okay? And that's forever. And so, we've been earning the dividends, if you like, everywhere in the world. You don't know today when a bank, interest rates go up. You don't know whether a bank's going to be hurt or not by that because you don't know how they're exposed to interest rates. They can be anything, okay? So these were some of them. Now, that's the swaps was 1980s, so we made progress. Okay, now I'm going to take you a little further out. And first, before I take you there, I'm going to mention that one of the things these innovations of both creating many more markets for managing risk, but also the finance science of how to design this, because none of these innovations could have been done without the mathematical models from finance science and the data. It was essential for solving these problems, whether it was option pricing or any of these other things, bond pricing, mortgage pricing, all of that required this. And it was this that brought finance science and finance practice together. Very sophisticated science in the sense of complex models and data and so forth. It got integrated into the mainstream of finance practice. And that happened in the 70s into the 80s, and it's still going on today. And so the most advanced work in science is getting used in practice in the mainstream. And this is, something that happened at that time, didn't happen before that. Okay, now I want to take us to the early 90s. I'm going to get you out of the United States and get you to a familiar place, Germany. Okay? And I'm going to tell you the story, this is an actual real story, of the city of Leipzig. It is, of course, you all know, reunification took place in the early 90s, and a country goal was to bring the economics of the East up to that of the West. So again, I'm telling you things you already know, but I'm just emphasizing that. So what would be needed for the economy to do that? The East had to grow. It had to grow to get up to where the West was. And to grow, you need a lot more electricity. You can't really grow very well in the economy if you don't have electricity. And how did you produce electricity? As it is today, you needed gas. Okay? So I'm going to tell you the story of the Leipzig. And what happened is Leipzig wanted to grow, increase its electricity, therefore it needed more gas. And I remind you, what was the features of Leipzig, or the East? Basically, command and control economies, fixed prices, sometimes supplies weren't there, but very stable fixed prices, not anything sophisticated. And that's what the population was used to. And by the way, the city managers didn't have a reason to be particularly sophisticated in finance. So the reason I'm telling you this is because that's background to keep in mind. All right, so what happened is they got two choices, two physical choices. Choice one was take your gas from the west, build a pipeline from Leipzig to, up to the grid in the North Sea area, as you know. Okay? And as you may know, as it's still today, I believe, is that this was a dollar market. In other words, the currency that was used, and it was actually related to heating oil, but that's just a detail. Okay? So it was a dollar market. Now, that was one choice. But they get a second offer from the East. Russia, consortium, said, hey, don't get your gas from the West. Build a pipeline to the grid in Russia, and you know what we're going to do for you? If you do that, we are going to give you 15-year guaranteed price contract in Deutschmarks. This is before Euro. In Deutschmarks for your gas. So X Deutschmarks per MCF of gas, fixed for 15 years. Now, putting in context, you say, wait a minute, this is a more costly pipeline. But they said, our constituents in our city are used to price stability. Imagine how much fluctuations they're going to see in the price of electricity each month with the combination of the volatility of gas prices and currency prices, Deutschmark dollar. And they said, this is a potential problem. Enough so that both the CEO of the gas company, but also the city managers, were seriously considering the Russian offer. Those are all facts. Now, in the period since the innovation I showed you before, in the 70s into the 80s, we developed a thing called financial engineering, which is taking finance science and solving real-world problems with it. That's what engineering is about in any field, okay? And so we created financial engineering, and not surprising, many institutions, and I'm going to talk about a particular one that was involved in this case of Leipzig, which was JP Morgan, okay, that they developed divisions, which I would call solution divisions. What they say is, instead of having a solution, a hammer as a tool, and then going out convincing everybody that their problem is that of a nail, so a hammer's the right tool, they took the opposite approach and said, we have potential clients out there, they have a problem. We'll go and listen to what their problem is, and then we'll figure out how to solve that problem. It's a different mindset. It's a solutions business rather than a product sale convince people business. Both of them are acceptable, but I'm telling you that's where it came. So JP Morgan, among others, developed a division with very talented people who, like some of the ones that are being trained here, who have learned all the tools of finance science and how to figure out things and hedging and all these kinds of stuff and pricing of complex securities, et cetera, as tool in their toolkit, so when they go out to solve it, they would be able to solve client problems, okay? So this division, remember, this is back in the 90s, this division got wind of this story going on, and they asked themselves, can we find a better solution than either choice one or choice two? And they did. Now, first I'm going to tell you what the solution was so you hear what the client heard. They went to the client and they said, we have a third choice. Take your gas from the West. That's the physical choice. Number one. Pay the spot price. Anytime the spot price that you pay is higher than the X Deutschmarks per MCF that Russia promised you as a fixed price, we, JP Morgan, will make up the difference. So you will never pay more than X. Now, I'm going to ask you, is this a hard decision to make? You have two choices. You agree to a fixed price for gas for the next 15 years, or you never pay more than that fixed price, but you may pay less. Is that a hard one to make a decision about? Does that take rocket science? Does that take a lot of finance knowledge? I don't think so. And that wasn't an accident. It was recognizing that the client was not sophisticated, and for them to make a decision, they really had to understand it. What is often happens in finance, and I'm sure many of you are quite aware of this, making it simple for the client, the customer, which makes sense, usually makes it much more complex for the producer. It's very easy to give advice as long as the client's taking the risk. But when you make up solutions and you make guarantees, now you're on the hook. It takes a wholly different thing. But that's what they did. Now, I want to take you in a little more detail on this solution because I think it was a really, really good example of well-done financial engineering solving a problem which is mainstream real economy. Not a financial solution, but solving a problem which is getting gas to Leipzig so they can grow with electricity. And so I'm going to take you through this to compare the Russia solution with the JPM engineered solution. So let's look at capital costs. If you did the Russian one, you got to spend $300 million for that long pipeline. If you do the JP Morgan solution, you only spend $50 million for the short pipeline up to the west, but of course you have to pay JP Morgan for that guarantee, for the cap, and they charged $125 million for that. So the capital costs were $175 million. So the first point, capital costs, Leipzig saved $125 million. If you think these are small numbers, remember this is at a different time and it's a city, okay? If you want to make it exciting, add a zero to everything. You know what I mean? In other words, don't think, oh, we wouldn't spend time on that. All right, now, the next thing is we say, okay, the capital costs, or what about the operating costs? Well, I already told you. If you pay X Deutschmarks per MCF to the Russians, if you take the JP Morgan, you either pay X or less, but never more. And so what do you save? Basically, you save, sort of a kind of a put option kind of payoff on the spot price. But I wanted to take you through this slide to show you there are other important risks that are harder to quantify, but very important. And I want to show you that even in 1992, the solutions that came out of engineering addressed these very important risks. And that's what I wanted to show you, what I think of as a really good engineered solution, not just say, hey, capital costs are lower, operating costs are lower, end of story. All right? And the first one is local political risk. Suppose they took the Russian one and agree to a 15 years of paying X per MCF. What if 2 years from now, from the time they signed it, the spot price was X over 2? Imagine what that's going to be like with the people in Leipzig. They're going to say, wait a minute, everybody in the world is able to buy gas at X over 2, and we're buying it, a city's buying it at X? This is crazy. Now, if you think you can explain hedging to a general population so they would understand that you got rid of a risk, but it didn't turn out you probably were better off not hedging, but you didn't know, all right? You're not going to do that. In my country, we've had that problem in California and so forth, so that's not a practical solution. And this could be a very serious problem locally. People are going to say, hang them. We're paying double for what it is. With the JP Morgan solution, that problem goes away because you never pay more than spot. Check the box. You got rid of that risk. Okay? Next one, contract performance. What's worse than being uninsured? Thinking you're insured when you're not. Because if you're uninsured and you see a risk coming, at least you can try to do something about it. If you think you're covered, you say, it's fine, and then you find out you're not. Well, what is that here? Russia had a record, even at that time, of reneging on contracts. So yes, they promised to pay, to fulfill that in Deutschmarks, remember, not in rubles or something, okay? But what if they didn't? Now you're in real trouble because you thought you were covered and you weren't, all right? What about with the JP Morgan solution? They're getting a promise from JP Morgan to pay up the difference between the two with the spot price, right? But JP Morgan was a AAA global bank, traded on a stock exchange with huge amounts of capital, and importantly, being monitored by the Bank of England, the Fed, the Bundesbank. Everybody in the world was looking at JP Morgan. And it was a AAA, a real AAA. Basically, their promise to Leipzig was bankruptcy remote. So, another check of the box. Don't worry about losing, contract performance. Okay? All in this one solution. Okay? But we keep going. There's geopolitical security risk. What's that? Sadly, we know what that is because that's a recent phenomenon. I mean, it's happened more than once, but it's in our experience. If you do the Russian deal, Russia controls the flow of gas to Leipzig. Simple. And there's always the prospect that they might, for reasons not financial, choose to turn a spigot off. So that's what I mean by geopolitical risk, and I don't think I need to tell this room about that risk in modern times, even though this was 30 years ago. And finally, I want to point out environmental risk. That's a very 2025 issue. We're all worried about environmental risk, climate. No one claims that pipelines aren't dirty, right, for the environment. But we do them sometimes because the benefit is seen as greater than the cost. But no one argues about that. By physically doing to the west, you had a much shorter pipeline. You did it to Russia, the reason that was 300 million is a much longer one, which means you're going to pollute a lot more area than you would if you did the western one. So the JP Morgan solution was even green. Not to say they were thinking about that, I'm not suggesting that, but just to point out that this is a solution that addressed many more risks than simply cost, which would, for most cases, be sufficient. And that's why I wanted to take you through it. I think it's a beautiful example of well-done financial engineering with an impact on society, the impact on Leipzig, okay? And so I wanted to point this out to you through this example. All right, now let me move forward. That was in the 1990s, so we're making progress, okay? And now, I want to stop and say, we're going to look into the future now. We're going to have a little more of the present, but then we'll go to the future. But I wanted to show you this chart. It's not my chart, one that Ardner, Barbaros, and Buckley, and Quinn and Roberts used, which shows it's a chart of financial innovation since the 12th century, okay? And those dots you're seeing are things like, not just products, but also things like double-entry bookkeeping, pretty big innovation, all right? And look at the picture. You may have trouble seeing the details on the right side, but that's purposeful, because I want you to see what the story is. The first part of the story is that innovation has been going on for hundreds of years of the kind that we talk about. This is not a new phenomenon. It's not new now with AI coming, or it's not new with fintech. That doesn't mean they aren't important and having big impacts. But we've been doing financial innovation for a very long time. But what does this picture show you? It shows you that not only we've been doing innovation for a long time, but what? Look at the distance in time between each innovation. On the left side, you can see each distinct bot. On the right side, you have to start looking under a microscope, because on the time scale, it looks like they're happening right after one another. Financial innovation was not only continuing, it was accelerating. And it is accelerating. Innovations that used to take 5 years or 25 are making 2 years and maybe 10. And who knows how fast they're going to move going forward. So what does this tell you? Well, if we look at the way both governments, when they're doing things, and companies think about a big innovation like a retirement system, you're going to revise it. What do they say you typically do? Go out and collect best practice. Find out what everybody else has done, put all that information on a table and sift through it and find pieces that you can put together to solve your problem. And it's good to look at what other people have done. But the statement I put up there is, best practice is not good enough for a best solution. Why? This picture. If there were no financial innovation, okay, then looking at best practice would be just fine. It's a little bit, you forgive me, I'd love to be on the Autobahn where at least I have more freedom, but in the US I don't have that. But I think I'm a careful driver, but I drive a little fast. And so I sometimes are driving along, and going along, driving along, and I'm looking in the rearview mirror to see if there's anybody going to interfere with my travels, okay? And then I say, wait a minute, I'm traveling at 30 meters a second, looking in the rearview mirror. Now, when can that work? That can work if what's behind me and what's in front of me is the same. Because I'm looking in the rearview mirror, I've got the same picture. But what if what's in front of me is a change? That's not a good model. We're going to have a lot of problems. Look at that picture up there. Do you think that things aren't going to change in finance? Is a good approximation to real complex reality? I don't think so. So what I say is, yes, look at best practice, but it's not good enough. Don't ask the question, what has been done? Ask the question, what could be done? And that would be true, as you know, in things like mobile phone technology, where we understood you could do it. We know we can do it, so it's not a speculation. It just hasn't been done. Then you stop looking in the legacy rearview mirror, and you start looking forward, thinking about what could be done, even if it hasn't been done before. And that's the message I wanted to give you here as going forward. All right, now we're in the 90s. Let's bring it up to today. And I want to show you some data, because I want to convince you, especially those of you who are starting out, you can look at all the innovations that have delivered social dividends over the last 40, 50 years. We've achieved a lot. But I tell you, there's much, much more to do. There's much more you can do to improve things than we've done in the past. Much more. I think that's kind of exciting, if you're going to spend your life working in an area. And why do I say this? Well, what I put up here is transaction costs of trading in markets. Stock markets, the first slide is of, this slide is of spread costs. What does it cost you to trade? Now, JP Morgan, when it solved the problem for Leipzig, it was a very simple solution for Leipzig. They were very happy. What did JP Morgan have to do? There were very few markets for laying off the risk. There was no trading of gas. You couldn't lay off the risk. There was no gas market. You had to use surrogates, heating oil, things of that sort. Swap markets were not 15 years, but 5, and et cetera, et cetera. So the number of tools you had to lay off risk was limited, which means you had to be very clever and have good models to handle the, obviously, what would be big tracking error. And you had to commit capital, because if you can't lay off the risk outside of the bank, you have to put up the capital in the bank, and capital is expensive. Okay? That was the reality. To do this, what JP Morgan today, would be very easy by comparison. And many institutions could solve that problem. Okay? And one of the ways I'm showing that is when they do all this trading, they're doing this trading not because they're speculating or anything. They're doing it to hedge risks, to get as much risk out of the bank to reduce their capital costs. Anytime they can get rid of a risk that's not adding value, so they're not saying, oh, we can forecast interest rates or stuff better, they can save money. They can produce the better product or product at a cheaper cost. What I wanted to show you these numbers, look at the dramatic fall in spreads. That's telling you that since the 1990s, the last 30 years, there's been a dramatic cost in the loss of transactions. And I've just shown you this one to get the point across, but I could show you across all the markets. In addition, a lot more markets have been created, so you can lay off more of the risk to begin with. So the point being that there's a big capacity since Leipzig for doing much better, lower cost in solutions. Okay? And I hope that excites you a little if you hadn't thought about it. Because if you can do that, that means you can do a lot of things that you couldn't do before. All right? Similarly, on asset management, mutual fund expense ratios, I show you a similar picture and you can see. By the way, I wanted to go back a moment and just point out to you, notice that the big fall didn't just happen in the US or in the non-US developed countries, but emerging markets, the cost of trading has gone down enormously. And it's continuing to do that. That says there's a lot of capacity to improve things, to provide solutions, Leipzig-like solutions. That excites me. I hope it gets you interested and excited for the future. Now, one last thing I'm going to look at here on the future. And I've got just a little while to do it, but I want to focus on with you. And that is, I'm going to take you through an innovation that was created entirely in theory and then brought into practice. And it's right in the middle of it. So I'm not sure whether it's going to work, how well it's going to work. But it really has been done. Okay? And this is addressing a problem in retirement, mainly a global innovation, meaning it will work in almost any country with a bond market. And the idea is to, among other things, address the issue of the informal sector, which in some economies is more than half the population. If they're in the informal sector, there are no records, no taxes, no nothing. They don't have a pension. They don't even have Social Security. But they do have a need for retirement. Can we provide an instrument that will allow them to save personally for retirement that works, given the educational backgrounds and so forth? So that was the original goal. And let me describe what it is. We call it a retirement security bond, okay? And let me just tell you what it is very rapidly. It's a government bond, full faith and credit. In the United States, it would be a U.S. Treasury. Here, it would be the maximum top credit of issue of Germany, okay, of the Treasury. All right? Now, that tells you immediately a lot about the product. Like, what happens if I own these and I pass away? The answer is, what happens if you owned a government bond and that happened? So a lot of your questions you might ask are already solved, so we don't have to get into that at all. What is different about this solution is its payouts. As you know, the typical bond pays semi-annual income, coupons, and then a principal payment. What we're doing here is we're creating a bond where you buy the bond, you receive no coupons, no payments for some number of years, and then at some future date, you start to get a series of payments, level payments for a certain number of years. It's a bond, of course, and then no balloon payment at the end. So does everybody get the sense of what that is? Now, why did we pick this bond? If you're a bond trader, you say, I wouldn't want to play in that. That's a terrible instrument. And I'm going to say to you, I wouldn't make it for you. I made it for people. Look at that pattern. That's exactly the pattern when you put your money in a pension, right? You put your money in a pension. Do you get anything back? Not until you retire. And when you do, you get a stream of payments. And so the idea was the pension bond. And this was first done in a paper with Arun Malatar and Dr. Shin from Korea and so forth, as an idea of something like having a pension bond. And then we worked together to get all this done, and it was called selfies for a while. I won't get in that, but we call it, I think, appropriate name for something like this is a retirement security bond. And that's what we did. And let me tell you the two features of the payouts. So the payouts are look like a pension, okay? The other thing is it's indexed. It's not euros. It's not dollars. It's indexed not to inflation, but to aggregate per capita consumption. Why? We're solving a problem here. What's a good retirement? Well, you know, each of you may have your own ideas, but if especially the students say, I don't know what a good retirement fee. I'll tell you what I think would be a good retirement, and you can make your own judgment. If you could continue the standard of living for which you become accustomed during your work life at the end, so how you're living, if you could continue that for the rest of your life, that's a good retirement. You don't have to take a cut. You don't have to. If you buy that, which I think is a pretty good prescription, then what is it if you were going to provide that? If you just give them inflation protection, like your bonds that you have here in Germany, or we have TIPS in the United States, okay? You're locking in, leave aside the tracking error of your own consumption, you're locking in protection against inflation, right? But what are you locking in terms of a standard of living? Whenever you bought that bond, you got rid of inflation, which means you've locked in the standard of living at the time you bought the bond. Now, if you're 27 years old or 32 years old, do you really want to lock in the standard of living when you were 32 to enjoy when you're 65? Think back in your own life. Would you really like to have the standard of living that was available? I'm not talking about because you're making more money. I'm talking about standard of living, you know, cell phones, mobile phones versus, you know, things that are connected to wires. In other words, the things that have improved the standard of living. The point is, if you want to meet that objective, you've got to cover both standard of living and inflation. And if you do that, then it doesn't matter when you buy the bond, whether you're 32 or 45 or 57. Because for most people, the reason that things change is either from inflation or general standard of living. So by having an index to that, you've eliminated those risks. You've eliminated having to forecast those things 10, 20, 30, 40 years out, who knows, okay? That's the reason we made it this way, as a solution, okay? Now, the way they're issued not with a fixed maturity. What they're issued is with dates. So if you have a 2040 RSB, that means you don't get any payments till 2040, and then you get, let's say, 20 years or 25 years of payment. If you get a 2033 RSB, it means starting in 2033 you get the payment. If you buy a 2058 RSB, you don't get any payments till 2058. And if you're 31, that's not a bad date for retirement, right? Okay? So they are different, and the Treasury issues these And then once they've issued them until they start paying, they always are available to be issued. Do you understand? They're not like a 30-year bond that you then issue new 30 years. You have those bonds, so there's a supply. Now, how do you know what ones to buy? When you go to buy a pair of shoes, what's the first thing you do when you go into a store or go online? You look at what shoes are your size. There's no point in looking at a size 6 if you're a size 12 and versa. Well, the same thing here. If you know you want to retire in 2030 or 2045 or 2058, you go to the RSBs that are of that date, and that's the one you buy. So in the end, even though you buy at different times, you're buying the same bond always. So what you own in the end is one bond, all with the same terms. So you, just like a pension, you understand exactly what you've got. You don't have a portfolio of all kinds of different bonds, okay? So those are the features of it. Now, someone will say to me, if I can make this thing change, I hope. Ah, there it is. People have said to me from the business, and quite rightfully so, they say, well, Professor, this is a nice innovation, but, you know, ordinary bonds are good enough, tips or whatever. You know, it's not perfect, but we'll just buy tips and it's good enough, and thank you, but it isn't worth the trouble. Well, you've heard that, I'm sure, many times. Good enough. Let me show you how good this is. Remember who's buying this. At least to begin with, we're thinking of individuals with maybe a 6th grade education, but adults who can look after themselves. The left side shows the pay pattern for an RSB, for someone who's going to retire, plans to retire in 2058, a long time from now. You buy the bond, that's a cash out, nothing until 2058, and if you retire in 2058, you get a stream of payments, exactly what you're looking for. Just like a pension. How many transactions? One. Now let's look at tips, or you could use the equivalent of standard bonds here in Germany. Let's look at the pattern of buying 30-year tips. That's a pretty long one, right? Look on the right side. First of all, you get a coupon payment every 6 months. That means you have to do something with it. And if you're most people, it's going to be a small number. And they're going to say, gee, forget about transaction costs, you know, like fees. Just think of, you have to figure out what I'm going to do with the money. You have to take care of it, go online, do something. It's an effort. And you look at this small amount of money and say, I can't be bothered. Well, right away, you've defeated the purpose. It's not practical. So pretending that people are going to do that is not a good assumption. Okay? How many transactions do you get until that bond matures? 61. 30 years every 6 months. And then what happens? You're about 8, 9 years before you retire. And you're going to get this big chunk of money which has to be reinvested. What rate will it be reinvested in? Does anybody know what interest rates are going to be in 30 years? I don't think so. So you have enormous reinvestment risk. So when people tell you good enough, challenge it by checking if that's really true. If you compare those two, they're not remotely good enough for the problem we're trying to solve. And that's why we go to the trouble to design something that works. And that's what I wanted to show you. Similar things we can do here is if people are going to use this, particularly people with modest formal education, they have to be able to understand what they're doing and how they get it. Now, the design of this, what does a person need to know in order to buy this bond, know what they're going to get, and be able to think about whether they have enough? Well, first of all, they have to know what year they're thinking of retiring. So they could either know that, or if you have no idea, look at what Social Security does. In other words, that's something that everybody can get the number for, even if you're in your 20s or something. It's not perfect, but it'll get you a number. So that's a piece of information that everybody has. All right? Then the question is, what's our goal? You know, you have to have a goal for a good retirement planning. Now, you may not make it, but you need a target. okay? What's the target? Well, let's say they're living now on 50,000. What's their target? It's 50,000. How they're living now. Why? Because it's indexed to cover both standard of living and inflation. You don't have to forecast how much you're going to be earning because of inflation or because of standard of living, because that's built into the payment system. You've eliminated not only that risk, but you've eliminated that information. And furthermore, if you think about it, you understand, all of us understand how we're living today. So if you're living on a certain amount of money and I told you your income's going to be cut by 40%, that's something you can contemplate and say, how would I like that? And that happens even if you have no real formal education. We know how to do that. So the two things you need to know are, one, how many bonds are your target? If each bond pays $10, and it's always the same bond, remember, then 10 divided into 50,000 is 5,000 bonds. And then down the road, you say, how am I doing for retirement? Today, I challenge anyone, even my MIT 140 IQ, 3 nanotechnologies and all this stuff, to answer the question, if they have $1 million in their 401k, which is a lot of money, how far are they to their retirement? Well, that depends, right? If interest rates are 5%, then they know how much they're going to get. What happens if they have, not 5%, 60 basis points? That's where the 10-year was 4 years ago. That's on $1 million. How much is that a year? 60 basis points, $6,000 a year. There's a big difference between $6,000 a year and 50. Okay? And now it's what? 4% or something. It fluctuates, of course. So now it's 40. So for the same amount of money you accumulate, you're either going to get 50,000 or 6,000. You have no clue where you are. And you can't know that unless you gather more data. Just trying to show you the difference of design. They don't have that problem because the bond explains what it's paying. So if they have 3,000 bonds, they know instantly they have 30,000 a year in retirement, or the age they're planning to retire. And then they can ask themselves, is 30,000 enough, or do I need to save more? Do I change my goal? Some will say, no way that I can live on that. I have to save more. Someone else might say, you know, my kids will be growing up. I'm not going to take care of them financially. And I love bird watching. That's my dream in life, is to watch birds. And I've got the equipment already. And it's not a very expensive thing. So actually, I may not need that much once they're out. You see how you can think about your own circumstance personally, rather than some hypothetical projection of something that is none of you. And you can do it without any formal education, because all the time we make budget decisions of whether we buy one thing or another, food or travel or fix the garage. That's the idea here. It's an example of a design principle which says if you design products based on what the customer already knows, you don't have to educate them. You don't need financial education. You don't need any of those things because they already know how to look at it. And that's a design issue. Just like J.P. Morgan solved the problem for Leipzig, we should be solving the problem for people who want retirement and creating products and solutions that are based on what they know, rather than saying they have to get educated, go online, get whatever. Do you see what I'm saying to you? And this is doable. And I will, because of time, I'm going to quit to take some questions very shortly. You've been very good audience, very nice and quiet. And I don't know whether you're awake, but in any case. But no, seriously though, but you know, if you look at this, I think you see the point I'm trying to make to you. And you know, who does that already with big consumer items? Automobiles. I'm not going to go into the explanation. All I'll say very quickly is, you get into a 2024 Ford, and you get into a 1964 Ford, that's a long time ago, the accelerator is in the same place, and it feels the same. You'll be able to drive either car without noticing a difference, even though the technology is completely different. It's no longer leveraged with linkages, metal, it's all electronic. But they know enough to say they don't want to make it complicated for you to drive their car. You know how to drive. And so they put in their products, they keep them the same on the areas that matter. It's an example on big scale of how you use technology. Even though the underlying technology is completely different, you keep it. What's the other one you all know? How many of you have heard on things like consumer mobile phones and so forth? If you have to look at the manual when you buy this thing to use it, you're in trouble. You want to just take it out of the box and be able to use it. Same idea. You design it so that people that buy it already know how to use it. So I'm just pointing this out more generally, not just as a specific example here, of how I think we should be focusing ourselves for developing solutions in the future. And you can get around having these clumsy, I'm going to educate people about finance. It's like saying you can't drive a car unless you understand how an internal combustion engine works. That's ridiculous, or at least I think most of us would agree. So now I'm just, be very careful. Okay, I'm going to have to quit. Sorry. I'll finish up, though, because I wanted to make sure, just with two quick things. We designed this thing initially for the informal sector. But when we got to the end of it, everybody can use this. People have pension plans, but want to get more than their pension or their Social Security will provide. You have people who have DC plans where they're responsible for at least some of the investments and take the risk, okay? And those are becoming more and more popular. They would make use of this. Who else would make use of it? Okay? Advisors, people who have, wealthy clients. Can you imagine how nice this would be for structuring things like an annuity for people in the family, second cousins or something of this sort? And finally, what about institutions? Pension funds, insurance companies that write annuities. This is a dream because you can look at your actual liabilities, not a hypothetical. Some have older people of certain kinds. Some have younger people. You can get an RSB to hedge that risk for the actual people in your plan. You got it? Okay. So that's on who will use it. And I'm very excited because you can see everybody would use it, institutions and individuals. Finally, I'll just mention, and I won't go through it because I really have run over time, why U.S. government bonds? Why not a bank? Well, that wasn't random. That wasn't say, hey, that's a good idea. But think of this. If a bank issued this, what's the first thing that your regulator would say? You have to have pages of description saying, yes, they're promising to pay you in 30 years, but they may not. And then they have a long list of disclosures of risk. That's not going to sell for these purposes. Okay? And you also, if these are going to become a tool for the retirement system, people retire every day in good times and bad times. You can't turn it over to a hedge fund that will provide it, provided that they can make a lot of money and they will exit when they won't. You have to have reliability. All right, on that I'll quit. I hope I've stimulated you to think about innovation from the past all the way through to the future. And I hope you will be excited about the idea of the potential for you of things to do in the future. Thank you very much.